So it's very important that whether you're a founder or a VC, you need to know that whatever you build is something that's going to be lasting for a very long time.
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave.
So at the next stage we're talking about is really about product market fit and experiments and scaling. And what we're saying here is that we're moving into the economic and components of this, because previously I was talking about the setting up the company, how the founders come together. But the key thing we need to talk about and understand is that startups require money, and there's a valley of death because they need a lot of cash to support them before they become truly successful and able to become profitable or break even. And the way to think about it is that investors provide capital for a price, right? And that price comes in 2 forms: economic rights as well as control rights. So that's how I would think about it. So economics in terms of what's the risk and reward that we share, and then the control rights is my ability to have a say or have a point of view about the future of this company. So in terms of economic rights, in general, in terms of capital provision, there's 2 types of capital that's provided. There's either debt or equity. And debt, obviously, is what we all understand is credit card debt or bank loans or receivables financing. But very much basically saying is like, I want to give you cash and you pay me back in cash. So that's pretty much a debt. And because of that, I will have collateral. I have the rights to certain assets of yours in order to make sure that if you default, then I will be able to pay myself back. And obviously, there are many benefits to debt as a result. And then for equity, you're providing capital, but then because I provide that capital, I deserve a share of the future rewards in the company, right? The future profits of the company, the future dividends of the company. And as a result, I think there's a bit of a bifurcation in the general economic upside as well as the control rights are available. The first thing to understand is that obviously debt, the benefit is that you are able to maintain full ownership of the company over the long term. But of course, equity, if your company fails, you never have to pay back the debt, right? Like upside risk versus downside risk. Another thing that of course is important is that equity financing is very much understood to be how home runs happen. So for example, as you move towards a home run, because you have that home run perspective, people want a share of that pot of gold, right? They don't really care about this debt perspective because they can always provide debt to companies that are much more stable and less risky. For example, an F&B chain or some sort of basic investment vehicle or property. So there's a bunch of different opportunities that are there as well. And of course, I think for debt, normally they will want collateral. That's their primary control mechanism. Versus for equity, they will tend to use more advisory or board control rights to get supervision over the use of funds. Zooming into equity, I think there are 3 major components that you often hear. And again, this is not meant to be fully exhaustive, but there are 3 types for you to be taught. There are either equity or equity linked. Preferred stock, there'll be a price round, convertible notes, and then as well as a safe note. So what I will try to explain this a little bit is that a preferred stock is your classic equity, buy percentage of your company. And for many of you, you also understand this from investing in the public markets, because when you buy in the public markets, it's a price round, you know what the price is. And so a lot of it is relatively straightforward. You as a retail investor have investor protection, similar to a preferred stock, a shareholder, because you're buying the company, the court does protect you with significant rights to say that you must have investor rights, you need to have information and audited financials, things like that. But of course, for price equity, you do need to assess the price of the company. For public companies, obviously, that's done by the supply and demand of what's available out there. But that can be quite difficult for a startup to value, right? So if you're a company, for example, that has $10 million of revenue, your valuation is $100 million, your technology is incredible and could create a unicorn company in 2 years, but you are 3 months away from dying as a company, what is the price of that company, right? And that can be something that be subject to not only negotiation, but also a lot of debate as well. Convertible notes and safes are simpler instruments that were generated over time. So in the past, if you go back 30, 40 years ago, all investments were done through price equity rounds. But convertible notes came second. And what they were was that convertible notes were basically saying, how do I create a debt instrument that allows me to be protected as a debt instrument for the next, for example, 2 to 3 years, but at the right timing, be able to convert into an equity type of outcome. So it's meant to be a simpler document which uses a short-term interest rate as well as some other control mechanisms. But basically, it looks like debt in the short term, but converts into equity at a future date. Convertible notes was historically built to make it easier for early stage startups to use less lawyer time, use less accountant time, and come to agreement about what needs to be done. The Safe Note was created by Y Combinator and has been updated several times and is an even simpler version of the convertible note. And what they've done is they simplified and removed even more investor protections in the interest of making it easier for the founder to operate, but also remove the interest component, which is a function of debt, but created, for example, a valuation cap and discount, which basically says that when there is a future price equity round, this safe or convertible note will convert at a certain percentage to the preferred stock equity round in future. So the safe note is the simplest version of the convertible note. For example, if you go back 10 years ago in the US, in the West Coast, a lot of people were using the YC safe note. And a lot of people in New York, for example, were very adamantly against using the safe as angel investors because they felt that safe notes were not protective for investors. And so they're using convertible notes. Imagine East Coast startups are using convertible notes and West Coast startups are using safe notes. I would say in today's age, 10 years down the road, it's a very different world from when I used to be fundraising as a founder. In today's world, I think East Coast and West Coast predominantly use safe notes in the early stages. And I would say globally, most people have started to use the Safe Note as a standard document as well in Singapore or different jurisdictions as well. So when you do a price equity round, there are 3 major documents that will come out. One is a stock subscription agreement. The second one is the shareholders agreement. And the third is a stock purchase agreement. So the first for stock subscription agreement is really talking about the terms and conditions for purchasing the shares. The shareholders agreement is really like the obligation, so a little bit of the constitution about voting rights, how things can be done. And then your stock purchase agreement is really about talking about the individual closing conditions for those purchases to be made. What I would say is really key is that whenever you make a decision and negotiate this current round for price equity round, it is something that's likely to be inherited by future shareholders. So it's very important that whether you're a founder or a VC, is you need to know that whatever you build is something that's going to be lasting for a very long time. So that's where I think some of the expenses rack up pretty quickly because people are very thoughtful about negotiating the best possible agreement even at the earliest stages. Last few slides that I'll say here is there are several components to think about. One is, of course, really about control rights is a big one. So control rights is that obviously once you have a price equity round, there would generally be a board of directors, which would be similar to other board of directors for public companies. They would hire and can fire a CEO, they can approve the budget, and the size would tend to grow over time. So obviously when a company is incorporated, it may be 1 or 2 people. Maybe if it's a solo founder, it could be the solo founder as the board of directors. Maybe there are 2 co-founders, the 2 of them on the board of directors. But when your first seed startup comes up, they may open up that board and they will start the process of creating good corporate governance. So they may have 3 to 5 board seats in the early stages. And then growth stage startup may have 5 or 7, or I've even seen 10 or 11 board seats as well. Now, obviously, decisions tend to be majority or super majority, depending on different conditions. And obviously, there's a little bit of debate between the right proportion and mix of it. So at the start, in the earliest stages, founders will have much more control. And then over time, as investors come in, generally there'll be more and more investors and they can eventually become the majority of the board at the late stage startups. Sometimes the founders and investors may agree to nominate on independent board directors, and independent board directors are supposed to serve as a bridge or as a neutral ground between both sides. Obviously, there's a lot of debate that happens there as well. Now, that being said, what I would say is that in general, the more successful a startup is in the early stages and the faster they grow towards a unicorn, the more likely the founder is able to maintain majority control even all the way to exit. So if you look at, for example, Mark Zuckerberg, even though he has a minority share in terms of his economic rights, in terms of a percentage of the entire company, he has a special class of shares that gives him control and voting rights that allows him to have an outsized control versus his actual economic control. But that's a function of the fact that Facebook grew very fast and was very successful, and investors were willing to give him more control rights, even though they were taking up economic rights for themselves to share in the risk and reward. The key economic terms for you to understand, the second last slide here, is in terms of equity rounds, is the valuation, obviously. So how valuable is the company today when you negotiate at price? The second is the investment quantum, which is how much the lead investor is putting in versus how much capital other investors are allowed to put in. So how much capital is joining in this round. Obviously, there's a pre-money versus post-money valuation. So for example, your last round was a 10 million valuation. I now want to put in $10 million more to buy 20% of your company. So your company valuation is now 10 times 5 equals 50 million. The pre-money valuation is $40 million. And after adding cash of $10 million, the company is now worth post-money $50 million. So there's a pre versus post-money. You just have to be aware that these are different things. And I've literally seen lawyers screw this up and have people and investors argue about this 1 year to 2 years down the road about pre-money versus post-money. So I just want to say this, that if you're a founder or VC, you should not necessarily trust your lawyers to draft this because math can be hard for lawyers. And I have seen tier 1 lawyers mess this up. So it's unbelievable. So make sure that you understand the difference here. Liquidation preferences are also quite key. So for example, there's a liquidity waterfall. So for example, what this means is that if you are at the top of the liquidity waterfall, your money comes out first. And if you're at the bottom of the liquidity or the waterfall, you'll be paid last. So for example, let's just say the last round valuation that you had was $100 million, but you sold to a strategic acquirer for only $50 million, right? So you have $50 million of proceeds, but the valuation was $100 million for the last round. The $50 million will only compensate the top 50% of the shareholders. So it flows in and flows down. So normally what is that your latest round investors tend to be at the top of the liquidity waterfall, then your Series B, then your Series A, then your seed investors, then your founders, and finally your employees tend to be at the bottom of this liquidity waterfall. So this is something for you to be quite thoughtful about. Anti-dilution provisions are basically saying that investors have the right to protect themselves from dilution over time. There's all kinds of versions of this, ratchet versus full weighted average, but they're quite significant and they actually can be quite onerous in Southeast Asia, primarily because of the smaller size of outcomes historically to date, but also the less mature VC ecosystem. So there's something for you to be aware of. And lastly, of course, is the employee options pool size, which is how much of the economic pool are we saving for employees? Because you as a VC, you're negotiating with the founder, but then the VC wants to make sure that there's enough economic upside to be shared with the key leadership team who are not the founders. So there's a third person in the room that are not being compensated for, and this is how they discuss and negotiate that.
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.